All right, welcome back. Mr. Mash here. I hope you are well. In this video, we're going to look at other special private investment situations. We'll focus on capital structure arbitrage. Particularly, we'll be looking at synthetic positions, synthetic long bond positions, synthetic convertible bond positions. Let's get right into this. The asset and credit default swaps. So we'll look at the mechanics of a asset swap and then we'll look at the credit default swap. The fixed bond pricing is going to be sensitive to both interest rate levels and issuer credit risk. In hedging strategy, the investor can use asset swaps to separate interest rate risk and credit spread risk. You will see how this works just now, but basically the hedging strategy is to separate the risk of the interest rate and the risk of the credit spread. The mechanics of the asset swap is that you take the bond and then you add an asset swap. So this converts a risky fixed rate bond into a fixed spread over the market reference rate. You see down here, the investor purchases a fixed rate bond, and from the fixed rate bond, the investor is going to receive a fixed coupon. Let's say this coupon is R. So the investor receives this coupon and then enters into this pay fixed swap, where the investor is going to pay a fixed rate and then is going to receive this market reference rate plus a particular spread. So the net cash flows in this instance is that the fixed coupon that the investor receives, they take them to this counterparty where they pay this fixed and then they're going to receive this. The investor is betting on this market reference rate plus the spread going up. So the bet by the investor is that interest rates are going to rise and they benefit from this. If the interest rates go down, then they are not benefiting much. They might as well have kept the fixed interest rate. So the price risk exposure after hedging, the price risk remains primarily from the changes in the bond's credit spread. So these changes in this spread are going to ensure that the risk of the price exposure stays. And then also in the default scenario, the investor faces a mark-to-market settlement on the pay fixed asset swap. So this is the pay fixed asset swap which the investor enters into. But should there be a credit event, then the investor loses the loss given default. Okay. And then with the credit default swap, this is insurance. This is insurance. For instance, an investor can buy protection. And if you buy protection, you pay a periodic premium based on the credit default swap spread. And you pay this premium to the protection seller. In the case of a credit event, the seller has to compensate the buyer because the buyer is paying for insurance. If anything goes wrong, the seller has to pay the buyer the difference between the par value of the bond and the recovery rate. After which, there is no further exposure. The credit default swap terminates and settles post-credit event, unlike an interest rate swap. So after this transaction where the seller of the CDS pays the buyer, there's no further exposure in that instance. Okay, and then let's look at the taking of long positions, right? So basically this slide is going to show us the bond versus CDS strategies in managing issuer spread risks. This can be done in two ways. Either the investor is going to take a long position using a swap and a bond, or the investor is going to take the long position using a swap in the CDS contract. In this instance, the investor is actually going to buy the bond. So when the investor uses the swap and the bond, the investor needs to own this bond. How does the investor own this bond? The investor is going to purchase this bond by borrowing. So the investor borrows the amount to purchase the bond at its face value D. And this money borrowed is going to, the investor is going to pay the market reference rate on the amount borrowed. And they purchase this bond with the borrowed amount. This bond is then going to pay the investor a fixed coupon rate R. It will pay the investor at the fixed coupon rate R. And then on this side here, the investor is going to enter into a pay fixed swap. The coupon rate the investor is receiving is going to be paid as a fixed rate here. So the investor enters a pay fixed swap. Okay, enters a pay fixed swap. And it's going to receive the market reference rate plus the bond spread. In terms of cash flows, you will see that the investor is receiving this coupon from the bond that they purchased using the money they borrowed. So they received this amount, and then in the pay fixed swap, they pay this amount to the counterparty. So this is a negative, which means these two are going to cancel out, right? They're going to cancel out. And if you look at the money they borrowed, they have to pay the market reference rate. In the pay fixed swap, they are paying a fixed rate, but they are receiving this floating rate, the marginal rate reference, the market reference rate plus the bond spread. So this market reference rate, they receive this and they receive this, but they pay this for the amount they borrowed, which means this and this will cancel. The only thing that is going to be left, because also the coupon they receive, they pay it in the fixed contract, then they're only left with this. So the net cash flow ultimately is just going to be the spread on the bond. That's what they are betting on. And then at maturity, they just receive the face value for the bond. They pay back because they took out a loan, right? They borrowed and they receive. So they receive this face value for the bond. They pay back the debt. And they get a net of 0. So that's the long position using a swap in the bond. With the long position using a swap in the CDS contract, in this instance, they don't own the bond. So they do not own the bond. Take note of that. No direct ownership of bond. Okay, so there's no direct ownership of bond here. What's going to happen is that the investor is going to put aside the money that is enough to buy the bond. So they lend the money that can purchase the bond. They put it into an interest-bearing account where they are going to receive this market reference rate, right? When they receive this market reference rate, the investor now is going to enter into a receive fixed swap contract. So they're going to receive this R. They receive this. If they're receiving a fixed, they pay the floating rate. So they pay this is minus, which means this and this can cancel, and this side is going to replicate the bond because you're getting a fixed return of R. Okay, you are paying the market reference rate, you are receiving from your deposit of the amount that equates to the amount of the bond. You are receiving the market reference rate, and then you pay the market reference rate in your receive fixed contract. So you receive plus R here. Hence, this and this are going to cancel out. And then, in this instance, the investor is going to sell CDS protection. So here, the investor is going to sell CDS protection. And then by selling CDS protection, the investor is going to be receiving this premium. The investor is going to receive premium, which therefore means that if you look at these transactions here, the investor is going to pay this market reference rate and receive the fixed rate. These cancel out, and then the investor also receives the premium. So the net cash flow, this is positive and this is positive. The net is the sum of this, the swap fixed rate and the premium on the CDS, which they have sold protection. But in the case of a default, if there's a credit event, then the investor has to pay the counterparty the loss given default, because remember, they sold protection, so they have to pay someone in the case of a credit event. Hence, you will see that the marginal, the market reference rates cancel out. You are left with the R plus S, which is the net cash flow here. Okay, and then eventually they are just going to get back their money. The net is going to be the deposit, the money that they put in. They get it back at the end of this contract. They get the face value of the debt. So the takeaway from this is basically that we put two synthetic positions, where the first one, you actually need to have the bond, and to get the bond, you borrow money, you get the bond, and then you enter into a pay fixed swap, where you pay a fixed amount. The amount you are paying as a fixed amount is the amount you are getting from the bond you purchased. You purchase the bond by borrowing money, right, which you are paying at a risk-free rate. It's a risk-free loan. Okay, and then the other one, you don't have to have the bond, but you need the money, which is enough to buy the bond. You don't buy the bond, you deposit that money into a risk-free deposit, and you earn a return based on the market reference rate. Then you enter into a receive fixed swap, where you are receiving a fixed amount and you are paying the market reference rate. And then also you are going to sell protection on the bond. And then by selling protection, you receive a premium. These are the two ways in which you can enter into these synthetic long positions. All right, so make sure you remember these synthetic positions. One in which you have to have the bond, and the other one in which you use the CDS contract by selling protection, and also you enter into a receive fixed swap. Okay, also if you consider the CDS spread difference, which is called the basis, this may arise due to bond price differences from par, accrued interest, and varying contract terms. The negative basis is when the spread on the CDS is less than the spread on the bond. In this instance, the investor is going to go long on the bond, because remember, this bond, if it is a higher spread, what it means is that it's cheap. This bond is cheap because it is a higher spread, right? Because it's cheap, you take a long position, you buy, and also you buy the CDS spread. Why? Because it's cheap as well. You are going to get a high return on your bond here, because the spread is higher than the CDS. So you're getting this high return and paying less for the protection. And this is done on the same issuer. So you go long if the spread on the bond is higher than the spread on the CDS. This is lower than the spread on the bond. So you're buying cheap protection, and you are buying this bond, you go long, and this you do on the same issuer. The benefit is that you profit as the basis narrows over time, akin to a long bond position. That's with a negative basis. Okay, this is with a negative basis. And so capital structure arbitrage trades to take advantage of relative mispricing between implied equity and CDS spreads may be summarized as follows. If you look at this, is a summary of the positions you can take. If the CDS spread is greater, this actually means that the protection is expensive, right? Because it's expensive, you make more money. You know, in the general rule of finance, sell high, buy low. This spread is expensive, so you sell the spread. When you sell CDS protection, you are receiving a premium, and then you're also going to sell equity short, which means you're going to take a short position on this equity. Okay, you borrow the equity, the shares, and then you sell them, hoping to buy them later on when they are cheaper. All right. And if the equity spread is above the CDS spread, in this instance, you see that the spread is now cheaper, right? So you buy the protection because the protection is cheap, and then you also buy the equity here. You also buy the equity and you buy the protection. This is the general rule that you have to remember. As the volatility increases, the spread is also going to increase. So as volatility increases, the spread is going to increase. You see here, this is low volatility, this is high volatility. At higher volatility, you get higher spreads. Okay, we're going to do this numerically using an example. Okay, let's now look at convertible bonds, which you are familiar with. A convertible bond, in terms of structure, it's a bond that has a property of equity, where you have this right to convert the bond into the shares of a company later on at a predetermined conversion rate. So this combines the straight bond with embedded call options on the issuer's shares. Some of the key features is that the investors can exchange debt for equity at a predetermined conversion price during a specific future period. You know that. Investors' attraction, the call option appeals to lenders hesitant about fixed rate. So a lender who's not sure, like they doubt that, maybe this company will not do so well, they put these options so that a person is attracted to get the bond. If the company doesn't do well, they get back their money with interest. If the company does well, then they have the option to convert into the shares of the company. So this usually happens. Remember, we said venture capital and companies that are still in their early or growth stages are the ones that issue these call options, these convertible bonds, because they want to attract investors. Some of them actually issue these with warrants as sweeteners to sweeten the deal so that they get more investors into these companies. So the markets are relatively illiquid, and often they're offered at a discount to raise capital faster than traditional offerings. So they're offered at a discount to raise the capital faster. So the building blocks of this is a synthetic convertible bond, right? This is a synthetic convertible bond, and we start off with cash. You put aside money that is equal to the bond's purchase price. You have money. You're not buying a convertible bond, but what you're doing with a synthetic long convertible bond, you want to mimic the behavior of owning a convertible bond without actually owning one. You don't have a convertible bond, but you do a couple of transactions that you enter into different deals such that at the end of the day, you mimic a convertible bond. This is done for various reasons. Maybe it's going to be cost efficient. It's cheaper to do these transactions where you enter into swaps and credit default swaps and equity positions than to actually get the convertible bonds. It might be more expensive. It's also flexible. You can customize things like your strike price, your call option, and this can be done to suit your needs. In some instances, you might not have these convertible bonds on the market. So you want to create your own convertible bond by using a synthetic position. And you can do this, you replicate these exposures using a strategy similar to the one that you can see here. So you put aside an amount of cash that is equal to the bond's purchase price, and then you put this money into a safe place. You deposit a risk-free deposit, which means you're going to earn this amount on this risk-free deposit. You earn the market reference rate, and then you're going to enter into a receive fixed swap. The investor is going to receive. This is a fixed amount that the investor is going to receive. If it's a receive fixed, it means you are paying the market reference rate. And what you see, this, you create a bond-like component. This is a bond-like component. The bond-like component. And what it basically means is that this amount is coming to the investor, but the same amount immediately goes out to the swap counterparty, the negative, which means this and this cancel out. But because you entered into a receive fixed, you receive this fixed amount. So this is sort of like your coupon payment on a bond. So you've mimicked a bond, you have a bond-like component. To get the convertible part, you enter into an equity option contract. So what you're going to do is purchase a call option on the bond, right? And when you get into a call option, when you buy a call option, it means you have the right to buy the shares of a company if the price goes up. Because remember, the call options, they are bullish. So the investor is going to benefit or exercise their right as the price goes up. And hence, the value of this call option is the maximum of the strike price of the stock price minus the exercise price, or nothing if they do not exercise. And they only exercise if the stock price exceeds the exercise price, if this is positive. All right. That's what they are going to enter on this side. This gives you the equity-like component. This gives you the equity-like component. So you have the bond-like component here where you get your fixed coupon, and you have the equity-like component where you have an unlimited upside because of the call option. As the value of this stock continues to rise, you have this a right, not an obligation, to convert or to buy the stock of the, not to convert, to buy, because you don't own a convertible bond in this instance. Okay. And then you are also going to enter into this a credit default swap where you sell protection. If you sell protection, you receive this premium. So you're going to receive this premium. You lose the loss given default in the event of a credit event, right? That's when you lose out. But you're going to receive this premium because you're selling protection. If anything goes wrong, you have to pay the buyer of the counterparty, the buyer of the premium, of the CDS. All right. So in this instance, so you have three components here. You have the bond-like component, which you get the coupon, and you have the equity-like component where you have an unlimited upside because you have the right to the shares of the company. And also this side now is the risk management. This side is now the risk management. Okay, we are trying to manage the risk by selling protection, so that if anything goes wrong, you have to pay the buyer that amount, and then the loss is going to be this loss given default. All right. So let's see. This and this have cancelled out, which means you are left with this coupon rate, and also you're going to receive this amount here. You're going to receive the amount at the end of this contract. You are either going to, because you put your money in a safe place, right? Either you convert and you receive the stock if there's a big upside, or you just get back your debt amount. In this instance, you have actually converted these different strategies into a convertible bond. You have a synthetic convertible bond without owning one, but you've managed to actually generate one for yourself. All right, so I hope this makes sense. You can always pause and try and see what's going on. But basically, the components of these synthetic convertible bonds are: you deposit the money, you put it in a safe place, which means you receive a risk-free rate. And then you sell credit protection, you receive this premium. And then you enter a receive fixed swap, which then creates this coupon. You receive the fixed and you pay the market reference rate. Then you purchase an equity call option matching the bond's conversion terms. So the equity call option that you purchase must match the bond's conversion terms. The benefit to the investor is that the convertible bond issuer sells equity volatility to investor via a lower coupon compared to the standard debt. So volatility is sold at a lower coupon as compared to the standard debt. All right. Let's go to the next. Okay, so capital structure arbitrage. Let's compare the convertible versus the straight debt. In terms of volatility, the convertible debt, the volatility has a direct impact due to the long equity volatility position, the embedded call option. So what this means is, if the bond is very volatile, the investor is going to benefit if the price of the stock continues to go up. They can convert, and they convert that into the stock of the company. But with the straight bond, the volatility is an indirect impact. It doesn't have a direct impact. There's an indirect impact, maybe in extreme instances where they fail to pay the debt, and because of that, the stock price goes down. So there's an indirect impact on the credit spreads and share prices via the structural model. Okay. And then the arbitrage bounds, the convertible bonds have arbitrage bounds. They are limited because of the convertible bond conditions. The straight bonds, there are no arbitrage bounds under the structural model. So straight bond, no arbitrage bounds. Convertible bonds, the conversion features set arbitrage limits for convertible bonds. Volatility, convertible bonds, they tend to benefit because of the embedded option. They benefit because if it's very volatile and the price of equity continues to go up, people are going to convert. But straight bonds, the impact is indirect through the structural model. Okay, the credit risk, an investor can purchase CDS protection to offset convertible bond issuer default risk. An investor can pay fixed on an interest rate swap to convert the fixed rate exposure on the convertible bond to the market reference rate. And on the equity volatility risk, an investor can use short equity positions or equity put options to hedge the equity market positions of the convertible bonds. So these are the key arbitrage strategies to manage or hedge exposures in convertible bonds. Okay, either you can purchase protection, CDS protection. You purchase protection that if there's a credit event, you're going to be paid back your money, usually the par minus the recovered amount. And to hedge against the interest rate risk, you pay a fixed amount, which means you're going to receive the floating rate. And then with volatility, an investor can use a short position, or they can actually purchase a put option. With the put options, remember the put options are bearish, right? So if anything happens, the value of the equity goes down. That's when you benefit. The payoff is positive when the value of a bearish asset goes down if you buy the put option. All right. So this brings us to the end of this strategy.